Well, while everyone's coming on up, I'm going to sit down if that's all right. Ula is very formal Norwegian part of this conference. I'm the sloppy New York part. So along those lines, I'm also going to suggest that you guys be pretty informal, and hopefully we can have a conversation as opposed to just strict Q&A. I find that tends to keep the audience a little bit more. And wherever Bob is, thank you. I should have known when you were here you were going to tee it up for me. My first comments were, after an environmental panel like that, is who the heck's going to pay for all this? So I'm hoping my panel will be able to enlighten us a little bit on that. When we put together this panel, I tried to do something a little bit different. I mean, we often come to these conferences and there's 4 big banks on the panel and they all speak the same language to each other. I think each one of my panelists works for an organization that's slightly differentiated from each other. So I guess if we could each introduce ourselves, a minute or two if possible. Maybe perhaps, I think starting with Michael. See, we keep trying to get rid of Michael, but he keeps coming back. So for those of you who don't know, Michael is now at ING. He's running their transport desk, I believe. Right. And before I put my foot in my mouth and say something wrong, I'll let you take it from there. And what are you doing at ING, Michael?
I don't know. They hired me, so I joined. No, so as you mentioned, 7 months ago, I joined the institution as the head of their transportation group. Transportation for us is relatively broad. It's auto, container, rail, logistics, and shipping. I'm personally responsible for the shipping portfolio. And what ING had decided was that it made strategic sense for the institution, which has always been very active in the shipping market, to move closer to their clients, especially where they saw a lot of opportunities. And so areas that had been previously covered out of Europe, shipping being one of them, they brought in the relationship managers here to provide coverage to our North American clients.
Well, welcome back.
Nice.
I think maybe, so what size loans do you tend to give? I mean, the sky's the limit for you guys?
Sky's the limit, let me. So bottom size, 25, upward anywhere of 250 million or higher for the right transaction. It would have, and of course for underwriting appetite, even larger if we thought we could syndicate it out further. So I don't think there's a limit per se. Right now there's also an awful lot of appetite in the bank market for doing new transactions. And I think we're one of those that are teed up to put that in place.
Great, thanks. So I think then maybe by way of introduction, we'll move from maybe the larger size of loan appetite, I'll call it, to then the lowest size. So I think, Morten, you're probably next in line as far as the size of your loan appetites. If you can maybe introduce yourself and what you guys are up to.
Well, Brian, you got it wrong the first time again. Our loan size is basically the same as ING, typical, sometimes between 25 and 50. We can do upwards of 200 million for an individual client, and we could go as high as 250 million. Where we stop are different. We are a bilateral lender, like a traditional shipping bank in Germany in the 70s or 80s. I think we've participated in one syndicated loan during our 9-year time in the ship financing business. We are a lender. We don't tie the provision of credit to M&A or bond underwritings or cash management. We are just a lender, an asset-based lender. Macquarie is the world's largest infrastructure investor and manager by a factor of 3. We weren't in shipping financing till 9 years ago. We entered because a lot of banks were leaving or shrinking. We've grown the business. We doubled it in size the last couple of years. We've been counter-cyclical. We were doing dry bulk investments, inverted loans in 2017, tankers in 2018, 19, 20, container ships before COVID, offshore loans, offshore supply ships the last 3 years. A lot of banks go in. And for the existing clients, we can do 2 things. We deliver what we promise, and we can do it very quickly. Our best performance was last year. We did a request to loan financing in 7 days. So we're there to do business. We're going to support our existing clients, and we're open for new ones.
Great, thanks. David, maybe next.
Sure. So Auxilior is an independent boutique private credit lender and lessor. We primarily operate domestically in the Jones Act Workboat Center, with deals ranging from intracoastal push boats to large specialty support vessels. Our lenses may be slightly different. We look at it more through an equipment lender lens. We're looking for predictable near-term contracted cash and collateral value. Our transaction sizes are generally between 5 and 50 million. On the higher end, we will look for syndication partners.
Thank you. And Stian, welcome.
Yeah. Thank you. Yeah, first, to avoid any confusion, I'm not with Maritime Partners, as it says in the brochure. It's Maritime and Merchant Bank.
That's an important distinction.
We are a first priority mortgage lender. That's the only product we do, and we do it well. We're probably the smallest bank here in the panel. We do up to 30 million in ticket size, as low as 5 million. So we focus on the smaller deals. The bank was established when all the other banks exited the smaller and medium-sized ship owners. We've been growing the book from 0 to about $370 million since 2017. We're lean and mean. We're an organization of 27 people. And yeah, we have a very experienced shipping board that replies fast. We have no scheduled board meetings, so we can act very fast. And yeah, I think we beat Morten's record by 7 days. We have 5 days.
Well, I think with the panel up here, we've seen an increase, I think, of lenders. I think probably David and Stian, perfect example of that over the years. So maybe Stian, sticking with you, how has this increase in lenders influenced your approach to ship lending?
We were pretty lucky with the timing when the bank was established. So we have a solid client base. We have a proven track record. So we've been able to, maintain client loyalty and also build up a reputation for being fast and efficient. And that certainly stands out when clients are coming for loans. If they're in a hurry to buy a ship, we show great flexibility. Our biggest advantage is probably that we have no prepayment fees. So that provides the client with the flexibility it needs for, exiting vessels and buying new ones.
Great. And I think maybe we could just bring it back down the line on that one. David, again, you're slightly different than, I'll say, the two big guys next to me. A little bit about how you guys are approaching the markets and what's your advantage, I guess, to use Stian's word.
So I think, like the others on this panel, speed, we don't have to go to a board for approval. We move pretty quickly. Our focus is more in the Gulf. We're one of the leading providers of financing in the Gulf for these Jones Act vessels. So we're sort of in a niche. We don't move that far out of that niche, and that's where we play.
Okay. Michael?
Yeah, I think for us, so we're not quite as fast as these guys. Maybe we can get something done in a week, but it won't be easy. Where we are highly competitive is with the larger ship owners with newer fleets. We're probably the cheapest cost of, well, not probably, we're definitely the cheapest cost of capital, certainly on this stage. And so that's where we can really provide, we can go very long. We have no prepayment penalties. We're relatively flexible capital, and we're cheap, but we don't really see the alternative lenders as competitors for the most part. They can simply just play in a different part of in the ecosystem.
So you don't view private credit really as a threat?
Not to what we do, because again, they're considerably more expensive. Might they on a single vessel challenge us because they can get something done a little faster? Possibly. But for the most part, ship owners are always looking for their most efficient and cheapest cost of capital, and that's, I think, always going to be us.
Great. Morten?
Yeah, I think where we differentiate ourselves is non-recourse financing, relying on the mortgage. We'll do older ships. We've financed a lot of ships for Mr. Burke. We're not afraid to do business with the crippled and unwashed borrowers of the world, and it's global.
Great. So, David, you were saying you're primarily focused on Jones Act. I guess, starting with Stian then, do you come into the U.S. market? Or are you primarily Europe-based? Or
We've done some business in the U.S. and we would like to do more, but we're pretty much split 50-50, 50% domestically in Norway through mostly arrangers, and then 50% internationally. We have offices in Singapore, Hamburg, Athens, and now most recently London. So we're definitely chasing international transactions as well.
Great, well, welcome. And Morten, you were saying, you kind of went through earlier a list of kind of different segments that you were interested in over the past years. Are you focused on anything in particular now, or general, or
You know, we tend to go where the traditional shipping banks aren't. So, for example, the Jones Act, the traditional shipping banks historically have stayed away from that market because of the complexities of both mortgage rights and U.S. flag cost differentials, but we'd be wide open to doing there. A lot of the banks that lost their shirts in the offshore industry in the last decade did not return to the offshore lending, and we've done a lot of that in the last couple of years. So we're countercyclical, and where investment banks and banks don't go, we're not afraid to be active.
great?
Yeah, for us, I mean, we can do Jones Act. Unfortunately for us, there's just not a lot of opportunities that really fit our box of what we can do. We're not going to do a 30-year-old tanker doing cabotage in the Gulf. It's just not, it's simply not our niche, but we're relatively broad. There are no restrictions with regards to asset class. We can and do everything. We're not very fond of offshore, as you'd mentioned. We didn't really lose any money. And actually, most of the sort of larger guys didn't lose a lot of money during the downturn. They just got a scare. And risk people tend to stay within organizations for a long period of time. So it's just not something that we have a ton of appetite for. It's not a no-go for us, but for the most part, it's something we stay away from unless there's a very long-term charter attached.
Right. Well, you mentioned offshore, and I think, David, I'm going to go to you on this one, which is, we keep hearing offshore in the U.S. is going to be the next best thing. We're going to be like Norway soon. Haven't seen it. What's your views on offshore wind in the U.S.?
Well, I think, none of the currently permitted projects are going to be put on hold. Those are moving forward. We aren't financing those. I think there's some unpredictability going forward. So we're really not sure. We're watching it closely. We do think that, the opening up of the LNG and sending it overseas is going to make power closer to parity with gas-fired generation. So at some point, we think the wind farms are going to come back. We think it's inevitable, but focusing on current projects and not doing anything until there's line of sight into permitting going forward.
Anybody else have any views on offshore wind?
Well, it's not polite to say it while you're in the U.S., especially after I've had a senator address us, but there's no question that the Jones Act is a big impediment to the development of offshore wind installation vessels and such in the U.S. And as long as that exists, that's a real impediment to financing opportunities for banks to play in that space. There's going to have to be workarounds.
Yes, we have lots of clients looking for those workarounds. They haven't quite figured it out just yet, but that's not bad. So speaking of that, I mean, it's going to be an expensive market, is my understanding, if even feasible at all. So sticking with you, Morten, then, I mean, what are your views on lending, and not necessarily just offshore wind, but do you require your clients to have employment lined up before you're interested in kind of talking to them?
No, I think we're incredibly data-driven. We look at, first rule, we try to think like the equity. So if it's a good time to invest equity in assets, it's a good time to lend. So that's the first one. We don't require employment, but if the spot market's very low, you might have a lower advance rate, but we'll be flexible with that. We don't require. We're comfortable with the spot market, but we're going to be guided by historical data and returns.
Right. Michael, if you want.
Yeah, I mean, we certainly don't require employment. The vast majority of our portfolio is vessels that operate in the spot market. They do tend to be with more liquid asset classes, so you have your tankers, your bulkers. There's just not a great amount of containers in the U.S., container vessels that we can finance here, but that's certainly all within bounds. Charters are great. On the LNG side in particular, extremely useful, and we can give very sharp pricing if you have long-term contracts, again, where we can be competitive. And quite frankly, we often compete with our other products that we're trying to sell, which would be private placements and the bond market, is that ship owners come and they see that they can get sharper pricing from the shipping banks on things that may be bondable.
Right. And, I mean, David, you're in a niche market, as you described it. Do you require employment before you lend?
We do.
Yeah. Dion?
Yeah, no, same for offshore, we require employment. But for the others, bulkers, tankers, containers, it's, yeah, we're fine with spot.
Right. And then I think, Michael, you just said something about equity and bond offerings and things like that and the state of the market. I mean, all in all, it seems like we've had a pretty healthy few years. Should we be scared? This is shipping after all. When things start going well, people tend to get themselves in trouble. I don't know, Morten, Michael, you want to start with that one?
I mean, we're waiting for some of our clients to get into trouble because right now they don't need us. None of it, they're not running with much leverage. I think that's going to change once pricing moves in the market, and you're going to have a smaller gap in the bid-ask spread versus those that are in the market looking to buy, and those that may be willing to take advantage of a better market. Where we're not there, but given where rates are, especially in certain segments, we do think that bid-ask is going to contract, and we know a lot of our clients personally have a lot of liquidity. I've never seen stronger balance sheets amongst our clients. Really, most of them are net cash, and they are looking to do something. They've been very prudent, so our cost of risk has gone down quite a bit. But I think they're also, due to their prudence, their fleets have aged, and if they want an ongoing business, at some point they're going to have to refresh those fleets.
Yeah, I mean, sort of several basic rules that we've always had is that if you're lending money at a time when shipyards are making money building new buildings or investing equity when shipyards are profitable, you probably make a mistake. You want to order new buildings when the shipyards are losing money on the contract. If Wall Street is supportive of the industry, that's the time to run from the industry. I'd take the Norwegian bond market as part of Wall Street today, and when the Norwegian bond market is giving unsecured bonds to non-investment grade companies at attractive rates, I think you should be worried. So if you go back over any 10-year period, when Wall Street is supportive, when the shipyards are making money, and the banks are giving it cheaper and cheaper, that's the time when all the mistakes are made. And I'm sure we're going to do that. We're going to see that again now.
Interesting. Scary. So we're talking new buildings now then, I guess. Obviously the lead time for new buildings is a little bit different. The expense, of course, in particular, and we'll get to the U.S. in a second on some of the new buildings. Relatedly, are you guys, and Bob just left the room, so I can ask the question now because I've heard him speak about this in the past. Do you favor, or do you think it's better for clients at this point to be retrofitting or new building? And again, we'll take the U.S. market separately. Well, maybe we'll start with the U.S. market. David?
So, yeah, we don't think it's cost effective for new builds at this point. We just think that, by the time you enter into a contract and you're looking at day rates, that the super majors and even the smaller players are just not interested. I think what we're going to see is more existing tonnage get reactivated.
So, Morten, do you have any views on that? Outside of the U.S. market?
In the U.S. market, it's pretty clear. I mean, a MR product tanker is estimated to cost you $250 million today, and you wouldn't get it till 2028, and you wouldn't have a contract when you ordered it. That's daunting. We'll stay away from that one. I think there's never been a time of more uncertainty and downside risk in the shipping markets than we have today. You have the Ukraine war unwind. It's difficult for me to see Russia settling for a peace where they're not allowed to sell their hydrocarbons to the world again. And then the question, will the world accept them and trade them again? We'll see. China registered 1 million EVs in August this year. and they expect to register more EVs in 2025 than diesel. So what does that, what does that mean for both steel, iron ore, crude imports into China? Uncertainty, high historic prices, long lead times. And then you have the issue you had in the earlier panel. What is the IMO going to do? Are they going to change CII so it actually works? Are they going to have enforcement rules? The only way that you're going to catch up to 2050 is if they really tighten up the rules and make it expensive. So new builds, to me, look awful scary today.
Yeah, I think for us on the new build market, our view is similar in that we view the prices as extremely high. For us, our clients normally come to us since they have access to capital relatively easily. They don't come to us 2 or 3 years in advance looking for financing. They'll come to us a few months before something is delivered, so we're not taking that type of tail risk. The issues really come to underwriting standards, whereas in the past, for certain ship owners, we'd go with relatively high leverage compared to the contract, 60-65%. Today, we will not provide that because we take a look at historical prices, we see where they are, and we simply assume a reversion to the mean for the most part, especially if there's any type of lag time in delivery, because we don't expect sharp amortization up front. But with regards to financing new builds, we just have recently, so it's not something we shy away from. It's really just a question of advance rate.
Right. I think, Stian, if you can chime in on that one.
No, we do not offer pre-delivery financing. So retrofits for us is an increasing opportunity for further growth. And it's also more sustainable to use old ships and make them last longer. So we're supportive of retrofits.
Okay. Well, I think I'm going to transition a little bit now. We talked a lot about the bones of the industry and what you guys do. I think we'd be remiss at this juncture if I didn't just maybe throw one word out there and kind of get your reactions. And the one word is Trump. Obviously, there's a lot going on right now. The 24-hour news cycle is now incredibly challenging. How's this going to affect shipping, in particular, I guess, in the U.S. and otherwise? David, I don't know, in the U.S., I mean, Biden stopped LNG, Trump's opening LNG, you're lending into the LNG market in the Gulf. I mean, what are your views on this?
We're super bullish, both on greenfield and existing projects. We think they're going to need a lot of the workboats that we finance. So, again, that's the positive. The negative is the, uncertainty of tariffs and what he's going to do in the wind farm space. So, but specifically with respect to energy, we're bullish on the LNG market.
I don't want to put anybody on the spot on that particular question, but anybody else have any views on the change in administration, how it may affect us over the next?
I mean, I think trying to predict what Donald Trump's measures, what it will do is kind of like trying to predict when the New York Jets are going to actually have a winning football season.
I'll leave that alone.
But I think as much as Trump dominates the news, I think China drives shipping returns. And what happens in China, the electrification of their automobile industry is an enormous transformation. From steel, from crude imports. So I think China is still a much more important factor than Trump. Tariffs for the U.S., as big as they sound, they're not that important to the U.S. economy overall. They'll have an impact, and I won't discuss positive or negative. I'll have my own views, but I said China is still the driver, and that's the one we still need to focus on if it's a ship owner.
I think at ING we agree with that, and I would also say if you take a look at where trade flows were during the last Trump administration, up until the pandemic, they continue to increase year over year. Now, it's not to say that coming in again, it won't get worse, so we're obviously, we monitor it, we proceed with caution, but I will say going into this potential cycle, again, for our clients, and I think for most shipping clients, their balance sheets are in better shape than they've ever been before, at least in my memory. And, the advances that we're providing are still relatively, even compared to historical standards, are relatively modest. So even if we go through a rough few years, we think the companies that we lend to are in shape to to survive that.
A Norwegian perspective, perhaps?
I think it's just important to try and filter out all the noise that's going to come. I mean, like Ola said in the previous panel, that everything changed in just 24 hours yesterday with tariffs, and then there were no tariffs. So just trying to filter out the noise and looking at the underlying numbers is going to be important.
Yeah, I mean, following on and to that point, LNG, for instance, I see these reports on the LNG order book right now, and obviously we're talking about very expensive assets here. Now, in theory, China is going to need a lot of it. U.S. is going to be opening, so more ton miles. Are we bullish on financing a lot of these LNG projects that are coming on in the next few years? I don't know, Morten, if you...
I mean, I don't think it matters what the people on the panel will do. The Chinese banks and leasing houses will finance 100% of the LNG carriers that get built. They seem to have an insatiable appetite for it. Macquarie is one of the three biggest traders of LNG in the world, and we're extremely bullish on that as a transition fuel source for the world. Would we look at financing speculative LNG carriers today in the world? The answer would be no. But it doesn't really matter because there's so much cheap capital available to finance anything anybody orders today. But I'll defer. Michael, you know this market better than I do.
I won't speak to LNG projects per se, but on the shipping side, as in the actual underlying projects. But with regards to the shipping side, I think we're relatively bullish long-term, bearish short-term. There will be a demand if the Trump administration is helping any industry, it's going to be the LNG industry for the shipping side. There will be additional capacity coming on. Once it's on, it'll stay on for a very long period of time. The appetite for LNG, both in Asia and in Europe at this point, seems limitless. So there is no, so from a long-term perspective, it's great, but for somebody that would be taking delivery of a vessel in the next 12 months that doesn't have employment, that would be problematic for them because these projects don't get off the ground in 12 months. So it's good, but for the long term, I think it's probably the sector that, at least for me, I'd be most bullish on.
Right. And I think, David, you're on record as saying you guys are very bullish on LNG, in particular in the U.S.
Yeah,
Gulf
I mean,
market.
that's our bread and butter, right, especially in the Gulf, so, yeah.
And maybe, Stan, I'm going to move on to you, but changing the course a little bit, one of the phrases we've heard recently several times is drill, baby, drill. I was sitting at this conference over at the Helmsley about 25 years ago, and I still had brown hair, and I heard someone call the death of oil, or that within 5 years we were going to hit max capacity, or whatever that phrase is, and oil was going to tail off from there. I haven't seen that quite happen just yet. And so VLCCs and crude tankers, we're going to have another big bump there or are we done? Next year, we're going to be done like they predicted 20-plus years ago.
I mean, for us, it's pretty hard. We started in 2022 taking a 12 to 24 month perspective on the tanker market, and we've been extending that perspective now for 2 years, coming up 3. So we still think that for this year and next year it will still be solid rates, and we're not afraid to go into financing of tankers going forward. We're staying away from VLCCs. They're a bit too big for us, ticket size, but the smaller ones we're definitely looking at.
Well, that would turn over our big guys here, VLCCs, tanker markets.
For the most part, on the tanker side, we're definitely open for business, and we're not bearish on it in the short to medium term. Long term, as you say, what happens in China is going to matter, but in the interim, we think there's going to be a demand. There's, with all the vessels that have moved into the dark fleet, those are, in essence, scrapped from an international perspective. They're off the market. So as long as you have some form of demand, which you will for the foreseeable future, we think rates will remain solid. And even if they dip, right, what's going to happen? A lot of ships have basically not been scrapped over the last several years because rates have been very high. Rates dip for a while, all of a sudden, maybe going through that next special survey isn't going to make a ton of sense for an owner. It'll end up in the scrapyard, and rates will rebound. I mean, it's one of the great things about the shipping industry, and, you know, for those that have been in the industry for a long time, it rebalances. Given in time, it rebalances. They're not permanent assets. There is always demand, so I think I know we're absolutely fine in the tanker space for the time being. Long term, I can't see 10, 20 years out.
Well, I think, Morten, relatedly, I think you might have been the person who gave me this statistic when we were chatting a couple of weeks ago. Michael just mentioned dark fleet. My understanding is a pretty significant percentage, at least rumored to be in the dark fleet right now, up to perhaps almost 10%. You guys, as big organizations, obviously must have robust internal compliance and the like, but with 10% on the water, you know, that must kind of creep into your space, and you guys must be very diligent about it. How do you handle that as a big organization?
Well, I mean, I think everybody here knows how pleasant the KYC policies are at all banks, big or small. I mean, if somebody in Macquarie got involved in the financing of ship in the dark fleet, they would be out of the bank that day, escorted out, and, you know, their laptop and phone and everything confiscated and checked. And I think that's the case for most of us. I'm not sure the dark fleet disappears as quickly as people think, because they're mostly carrying sanctioned hydrocarbons, which are still going to be moving. And I think there'll still be room for them. I mean, it's a kind of amusing world. You have people gluing themselves to, you know, Monets and Picassos in museums and blocking traffic in London. Yet the IEA has now raised its forecast to 2030 that will be taking about 106 million barrels a day of oil consumption. So, I mean, I agree with Mike. I think we're optimistic on the tanker market. We'll be active. You know, if you're an LR2 player and you look at that order book, 37.5%, you know, the order book's equivalent to 37.5% of the fleet on the water. You might be a little more careful there, but, you know, we think the tanker trades are going to be active and healthy, and we'll be a big participant in the next few years.
So we're not calling peak oil today?
We're not.
Okay. Well, we're running a little short on time, so I'm going to give you guys one opportunity here to do what you might not often have a chance to do. Do you have any questions for each other? Okay. I'll leave that alone.
I'll ask a question. How long can large ship lending institutions lend money at low rates to non-investment grade companies and justify the business?
I meant a nice question.
No, that wasn't.
I think that's a very fair and pertinent question, actually. So, a couple of things is that if you take a look at the historical defaults within the larger banks, which some of our LGD models are based off of, they have been very small. And so that's that changes.
You took out RBS and you took out DVB.
Well, I'm talking about us, right? Because you
Okay.
run it off each institution runs it off its own models.
Okay.
With that said, with Basel IV, that is changing. And it's much more difficult for asset-based lenders to get that preferential capital treatment. So to your question is that right now, given the very strong markets that our ship owners have had over the last several years, they've been able to drive margins down very much to their benefit. That will not continue forever. They're basically stretching where the banks are now looking at this and saying, well, you know, we can stretch and we can get there at these levels, but we can't do it indefinitely. So the banks still want to be relevant, but at some point, the cost of capital, I do believe, will go up. Of course, I've been saying that for years, and it keeps going down. But I still believe it. It's got to be true, right? And again, the difference between where we would lend and an institution even like yours would lend, there's a huge gap. So is there room for a 50, 100 basis point increase at some point in time? Not today. Again, there's too much capital and not enough deals. I think the market can sustain that. And basically, that just brings us back to where historical norms were. And at that level, we're still profitable.
All right. Well, there you go. That's pretty much time. So I'm going to ask the panel one more quick question, rapid fire. Black swans, what keeps you guys awake at night? No? No black swans. Okay, so we're going to open it up. We have 1 minute for questions, so hopefully you can get 1 or 2 questions in. No questions? All right, well, then I guess we'll just leave it at hurry and get financed right now before it goes up another 100 basis points for all of our non-credit worthy participants today. Thank you.
Good job,